Welcome everybody to the third class of this course on Law and Finance. Let's take a look at today's program. In the first part, which will be the subject of this video, I'm going to talk to you a little bit about economic theory. And today we're going to discuss deflation after discussing inflation last time. And we're going to have a look at asset crisis. What's that? How does it work? In the history part, I'm going to discuss with you the period where deflation and asset crisis came together, and that is the Great Depression. And that makes for a great transition to the second part, to Karl Polanyi's Great Transformation, which we'll discuss together in our live session via Zoom. So let's get started with the first part. Last time, I explained to you what inflation is. Now, inflation takes place when there is a change in the relationship between the quantity of goods available in an economy and the quantity of money. When the quantity of money increases, each unit of goods in an economy will be more expensive. When the quantity of money decreases while the quantity of goods stays the same, prices will shrink. We've got deflation. And the same can happen on the goods side. If the quantity of money stays the same, but the quantity of goods increase, then we've got less money per good, which means deflation. And if the quantity of goods shrinks while the quantity of money stays the same, prices will get more expensive. That's the basic idea of inflation and deflation. And last time I discussed with you how inflation can end up in a circle where higher prices lead to higher wages, lead to higher production costs, lead to higher prices, and so on. And it all goes around. And exactly the same thing can happen with respect to deflation. Prices get lower because there's less demand. So there is less profits for companies. So they reduce their production because it's not worth it. That increases unemployment. That means people have even less money to spend on goods and services. That means there's yet an oversupply of goods and services. That means there will be even lower prices. And so you get a downward spiral. You can get an upward spiral and a downward spiral with prices. That's what can happen in an inflation crisis, or similar just with, just in the reverse way with a deflation crisis. Now let's go on and let's take a look at asset crisis. Asset crisis can happen with respect to any kind of asset. The most common asset crisis that you might think of is a housing bubble. That's exactly what happened in 27-28, and that triggered the great financial crisis. And we're going to discuss that in detail. But it can be different asset crises. The asset crisis that triggered the Great Depression at the end of the 1920s took place on the stock market. So it was a crisis of investments, of shares, actually. Now let's take a look at the normal course of things in a asset crisis. This is a scheme of asset crisis, by the way, if you're interested in the way in which such crises work out. Take a look at this book by Charles Kindleberger and Robert Alibur, Maniacs, Panics, and Crashes. It's appeared now in its 7th edition, and that is really a wonderful description. You don't have to be an economist to understand it, how such crises normally take place. And the schema I'm explaining to you is more or less derived from that book. Now, what's happening with an asset crisis? First of all, we've got a bubble that needs to emerge, so that is an exaggerated price level. Asset prices rise continuously over a longer period. And that takes place when there is trust that asset prices will continue to rise forever, that it will go on like this forever. That's a typical thing. You assume you've got the bias that things will stay the same and asset prices will rise and rise and rise and rise and rise. And that leads to a number of imprudent actions. For example, prices rise beyond the level where justified by demand and supply. Last time we had this demand and supply curve, and at a certain point they meet, and that's the optimum price. So in an asset crisis, the supply and demand curve where they meet is not representative of the actual price. The actual price will go beyond, what is justified by these two curves. And that can happen because people buy these assets on a loan. They take on loans and buy an asset. For example, they take on a loan to buy a house, and that loan, the quality of that loan can decrease, which means they have less and less and less capital. They're more and more leveraged. Their debt gets higher and higher because they think the prices will rise forever. So the rise in price will cover up the loan. That's what they assume. To the point where they have no own capital that they bring to an asset purchase, so they purchase it purely on a loan. And another phenomenon that typically happens is that in such an asset bubble, at some point you can sell anything. For example, in a housing bubble, you can even sell real estate that you normally wouldn't sell, or not at least not at this price, because it's just not a very attractive building, etc. Or shares, you can sell shares that are issued by companies with very doubtful credentials. But still, since it's a bubble, you will find someone who purchases it, probably on borrowed money. And then you've got the perfect recipe for disaster to happen. And disaster can strike anytime, and nobody knows when it will strike. Sometimes people have the feeling, well, no, this bubble is going to burst anytime soon, but nobody knows exactly when it will happen, because it can be a very small event. For example, one market participant goes bust, and then all of a sudden a lot of people realize, hey, oh dear, he was highly leveraged, he has a lot of loans, or what does that mean for my asset prices? And so they start to be concerned. And then, the whole spiral is running, and there's very little that can stop it. And how does that take place? Now, the downward spiral is somehow the exact opposite of the bubble. Prices go into a very fast downward movement, and typical trajectories are the following ones. Now, some investors borrowed all the money they needed for the asset purchase. If the asset price goes down, they might not be able to service their loan anymore. Because the loans were built on rising asset prices. For example, speculative purchases. You think that if you buy something on a loan, even if you don't have money, you will be able to sell it at a higher price, and you will use the price difference to pay back your loan and make a benefit. If the price declines, that doesn't work anymore. So your loan goes bust. So you have to sell the asset. If that happens to many, many people at the same time, asset prices will decline. That's a so-called fire sale. And the bank that extended your loan might also not be able to recover it. So banks might go bust at some point because they extended too much credit. And then the crisis is in full swing. Now the question is, what can you do to safeguard such a situation? An immediate reaction is normally to suspend trade, especially if a crisis takes place on the securities market. Then trade in securities or in certain investment instruments is stopped for a certain period until things calm down. It's kind of meant to take out the irrationality of fire sales. But on the other hand, these fire sales, they're pretty rational. So it's something that doesn't work long term. So you basically end up with two alternatives. Alternative number one is there's a bailout, normally by the government. That could be government subsidies. That means fiscal policy. The government, for example, sets up a bad bank that takes all the bad loans or the bad assets, and the good ones, they stay in the private sector. So the state covers up for the losses. Or it could be the central bank that provides credit and pushes liquidity into the system. The risk here is, of course, moral hazard. That's an important term. Moral hazard means people rely on the state bailing them out, and they act irrationally, and they take up unreasonable risks because they know that if things go wrong, there will be the government to bail them out. And that is why it is so important to keep moral hazard under control, because then the government will lose money otherwise. The second alternative is a bail-in. The government just lets things happen and accepts that there will be bankruptcies, be it of individual companies or of central banks, banks. And the central bank doesn't extend liquidity to the market. It stays strict. It keeps its money together. Now, that will reduce the financial risk for the state in the short term, but in the long term, this might even further deepen your crisis. Because imagine if a bank goes bust, how many of its customers will be affected? Now, normally you will say we have got deposit insurance. We will come to that, but deposit insurance means that there is a governmental scheme by which deposits, the money that you brought to your bank, are insured up to a certain amount. In the European Union, it's up to 100,000 euros. So you should say, oh, what's the problem if a bank goes bust? People are insured. Well, only if they don't have more than 100,000 euros. That might be enough for most of us, for you and me. I don't have 100,000 euros on my bank account. But imagine you're a company. A company can easily have more than 100,000 euros on its account at any time. Imagine if a big company needs to make salary payments. They might have millions on their account at one point, and that money will be gone. So most likely, the company will be in big trouble or will go bankrupt too. So you've got a spiral you've got a spiral of bankruptcies here, and that's normally not a very good strategy. So most often, at some point, governments decide to bail in. Now, so much for the theory part. Now let's go to the Great Depression. The Great Depression is the perfect example of an asset crisis combined with a deflationary spiral. And this is how it happened. In the 1920s, the US stock market went through the roof. Low interest rates in the United States encourage people to invest on the stock market because you might get a better benefit if you invest in shares. Now, why were interest rates so low? Because the government wanted to prevent money to be pulled from Europe to the United States. Woodrow Wilson and following governments wanted to keep Europe calm. Europe was still, in a post-war or interwar. They didn't know it was interwar then. In an interwar stage where things were quite precarious, lots of violence. So they wanted US investments in Europe to stay in Europe. And that's why you have low interest rates, because it's unattractive to take your money back. Now that spurred speculation on the stock market. More and more people were investing there, so prices go up just because more money flows to the stock market. And at some point, you have this belief that growth of prices will continue forever. And then people lose their caution and people buy assets, stocks on credit, on loans, and they pledge the assets as collateral. So you take a loan from your bank, you buy some stocks, and the stock serves as a collateral for your loan. And then it took just a minor bankruptcy of, I think, a copper producer somewhere, a mid-sized company. Size doesn't always matter in this respect. So it could be a small company that just tells everybody, hey, something is rotten in Denmark or something is rotten on the stock market. So there's a lot of exaggerated prices because there's a lot of expectation that probably is not in line with economic fundamentals, with the actual situation of a company and with the actual dividends and long-term value increases that you might expect. And that spreads doubts and mistrust across the entire financial sector, and then people begin to sell their stocks. Because they think, oh dear, let's get rid of these stocks as long as they still are worth something and before there's a total decline. And that means the more people selling their assets means prices will even further decline. And they might decline below a certain threshold which people have agreed on with their bank as the relevant threshold for so-called margin calls. So a margin call means when the asset price that you pledged as a collateral, when the share that you pledged as a collateral for the loan with which you bought the share sinks below a certain threshold, you need to provide additional collateral. How do you provide additional collateral? Well, you sell other shares. And so prices decline even further. And there are even further margin calls, and there is a need to sell even further assets. And then you're in this downward spiral. And there are lots of fire sales, and there's very little that can stop prices except government intervention. And that is exactly what happened on Black Thursday, Friday. It's called Thursday, Friday, Tuesday because this precipitous fall of prices actually extended over a number of cases. There was a weekend in a number of days. There was a weekend in between, but that weekend didn't last long enough to calm down the situation. And then on Monday, everything was closed, but that didn't help either. And on Tuesday, it just went on. And Tuesday, that was the 29th of October in 1999. And then it was clear that the stock market would not continue as it did before. And then the question was safeguarding it or not to be, to remain within this Hamletian metaphorical language. Now, what were the effects and reactions in the United States? Well, there were lots of bankruptcies on the private market by people that had bought shares by banks. A banking crisis ensued because there were so many loans that people couldn't pay back. And then, if one bank collapses, it's very likely that all the people that had business with this bank will also be affected. There will be further bankruptcies, and then there will be further banks collapsing from that effect. And that is exactly what happened between 29 and 33 in the United States. And the problem is that at that time, the role of the central bank wasn't well enough understood. So the central bank should have extended liquidity to the market to keep banks afloat. Even banks that had lots of trouble, that didn't really know what should happen with their loans, they should have kept them afloat. Because in a typical asset crisis, what happens is that after a while, asset prices recover. And one of the reasons why the Fed acted as it did was that it didn't have the information whether banks would still make it or not, whether banks were only illiquid, lacking liquidity, while the assets they had were still valid or had still a chance of recovery, or whether they were insolvent and would have needed to be restructured. So there was this information gap. At that time, there was no banking supervision as we have it today, and the central bank, the Federal Reserve, was just left in the dark about the actual economic situation of their banks, and it needed to act fast. It all occurred within a few days. So at that time, they decided not to extend liquidity. Instead, the Fed even raised interest rates because it thought that the key problem had been asset prices and that it should target asset prices. That is also an interesting way of understanding a central bank mandate. Nowadays, as we will discuss later in our class on the European Central Bank, nowadays we assume that the task of the central bank is to keep prices stable, to keep the price level stable, to fight inflation. And they thought they should fight asset prices. Now, asset prices is not the same as inflation. Inflation has something to do with the quantity of money versus the quantity of goods. But the individual price of one product as opposed to the other products, that is a different matter. And at the time, the Federal Reserve really thought that this should be their chief concern. So to bring down the bubble. We see these things today a little bit differently. Now, what was the result of this non-intervention of the Federal Reserve? Well, this chain of bankruptcies just continued unabated, and what happened was a deflationary spiral. People had less and less money, so they bought less products, so there was less demand, so prices declined even further. So some people had to be let off by companies, so people had even less money, and there was even less demand, etc. And then the spiral just went down, and the result is quite astonishing. It was an enormous GDP collapse of 33% within the first year. Unemployment rose by 22% within the 4-year period between 1929 and 1933. Compared to this, the global financial crisis occurring in 2008 pales. The decline in GDP and in employment only amounted to 5% that time. So it was a multiple of the impact of the global financial crisis, and that's quite dramatic. Now, that crisis did not stay in the United States, and that is very typical in a highly interconnected economy, and there's probably no economy that is as connected as the United States, and on which so many other economies depend, even then already. Now, Europe was highly vulnerable because of its high level of war debts and reparations that it still had to pay back, and still being in the process of recovering from the war. Now, what happened to the US investments that somehow kept Europe alive at the time? I told you that there were many investments, which is why the Federal Reserve or the US government did not want to raise the interest rates during the 1920s in the United States. Now, once the crisis spread in the United States or took place and it developed, people needed money. They needed their investments from overseas. So there were many capital calls, which means people withdrawing their capital from Europe to the United States against expectations in Europe. Yeah? At the time, in order to facilitate these investments, the gold standard was still accepted by many governments, or many governments had committed to the so-called gold standard, which means that they tied their currency to a fixed amount of gold, so that all the currencies have stable exchange rates. The mark was tied to a certain amount of gold, and so was the dollar, and so was the pound. So you could easily make international investments, and that's what they wanted. But in the crisis, that had a fatal effect, because then people could withdraw their money at no loss. Otherwise, without the gold standard, what would have happened? Well, the exchange rate would have done the job. If there's capital calls, if people want to exchange mark against dollar or pounds against dollar, etc., then the price of the mark, less in demand, or the price of the pound, less in demand, would decline as against the dollar, and the exchange rate would kind of serve as a cushion, as a valve for these developments. But the exchange rate didn't exist due to the gold standard, so that capital flight or these capital calls could continue without any inhibition, and that triggered and intensified an economic crisis in Europe, and also led to banking crisis there, because people were lacking capital, and then they could not repay their loans, and then you had the whole deflationary spiral just happening in Europe. Let's zoom in on a couple of countries. How were the reactions in Great Britain? Now, Great Britain had a huge current account deficit and experienced a lot of capital flight as the consequence of the stock market crash in the United States. And that brings you in a difficult situation. If you've got a current account deficit, that means that you have to provide for a positive inflow of money into your economy. How do you do that? Well, high interest rates. You offer high interest rates. But high interest rates in a deflationary situation are terrible. So that just led to very high unemployment. That lasted until 1931, when Great Britain discontinued the gold standard, which was about the smartest thing they could do. So they stopped the whole thing about capital flight and the importation of deflation, which went with it. In the United States, the gold standard was also abolished in 1933. Ultimately, the government, not the Fed, had decided that they needed to inject liquidity into financial markets. And if you want to inject liquidity in the financial markets, that normally means low interest rates. But that could have the effect that money goes away, that investments go abroad. And to prevent that from happening, they discontinued the gold standard. And it even went as far as prohibiting private gold holdings. You were no longer allowed in the United States to hold gold privately. There was a small exception for jewelry, but limited. And they actually managed that because they offered to purchase your gold at a price a little bit above the market for a limited period of time. And then people brought their gold and then it was gone. And then they could basically inject all that liquidity, and that stopped the crisis from spreading any further. Another reaction by the United States was the New Deal. A lot of government-funded programs that were meant to restart the economy. So a little bit the predecessor of the programs that President Biden is currently implementing. That is why there's so much talk about Biden being the new FDR, Franklin Delano Roosevelt, who was the mastermind, the president that led out the New Deal. And that was a highly successful program because it effectively lowered unemployment and therefore helped the United States to overcome this crisis relatively fast. Things, as you might know, went differently in Germany. Germany could not exit from the gold standard because of the Young Plan. Now, the Young Plan was a plan for the restructuring of German war debt. We don't have to discuss the details here, but a part of the Young Plan was the commitment of Germany to maintain the gold standard, to make it attractive for investors, because it also needed money, but investors wanted to have security that they would get back their value and that Germany would not inflate away its debt as it had done already in the early 1920s in the Great Inflation. So Germany should commit to a solid monetary policy, and that meant also maintaining the gold standard. So the only option for the government to ensure it could still repay its debt, its reparations, was to save money. And that is about the exact opposite of the New Deal. If you save money in a deflationary crisis, it means that there's still less money available, there's still less investments, that prices will sink even further, and there will be more unemployment, etc. So what began was a inflationary downward spiral. Germany, just to recap that, Germany was tied by the gold standard. It could not just prevent capital flight from happening. So capital flight was taking place. Still, they had to repay their debts. To repay their debts, they had to save money, which was the exact opposite of what the situation would have required to stop deflation and capital flight, namely investments. So they couldn't make investments. They had negative investments, if you so want, and that just further increased the crisis up until they reached 30% unemployment, which is quite dramatic, I think. And that, of course, had also huge consequences for the banking sector. So in 1931, there was a banking crisis, and that banking crisis saw so many banks collapse that ultimately it turned into a sovereign debt crisis. And then at some point, sovereign debt just became too much despite all the austerity, and the government of Brüning, the chancellor at the time, had to default on its reparation debts. And that led to even further capital flight until a moratorium was granted by President Hoover and the Bank for International Settlements in Basel and other creditors. But at that time, it was already too late. January 33 saw Hitler's grab of power, and then Germany simply discontinued to repay its war debt and declined into dictatorship. The rest is history. That was all for the first part, and I hope to see you soon on Zoom for our discussion of Karl Polanyi's work, which really masterfully shows the development leading to the Great Depression. Thank you.